Welcome back to the Two Stewards Show. My name is Mark. I'm here with the lovely and talented Brent.
Hello, everybody.
And we have a special guest. I mean, very special, so you don't have to listen to us rant. Well, to me rant. We have Dan Patton. Yes. And Dan, I just want to give you a big pat on the back for coming in today.
I saw what you did there.
I'm not wearing my dad joke shirt. Sorry, wrong shirt. But thanks, Dan, for coming into the show. We appreciate it.
Yeah.
And sorry, you're with BM
Better Mortgage Select.
Better Mortgage Select, yeah. Mortgages. So, yeah, welcome. Awesome.
Thank you.
It's good to have an actual expert on the show who hopefully you know what you're talking about. I heard you at a few events and, seem like you know what you're doing.
Oh, thank you. Been doing it a long time.
What do you guys do at BM, Better Mortgage Select?
So we work with all different sorts of home buyers, investors, whether they're first-time home buyers, whether they're homeowners looking to consolidate debt, whether they are people looking to buy real estate, expand their portfolios. We work with all sorts of clients who are looking to basically borrow money from the banks for mortgage purposes. Not an easy world to live in. I'm not sure how many times people have gone to the bank to try to get a mortgage, but it's tough. The banks are great product-wise, and banks have great people, but they can be difficult to play with when you're trying to borrow money. The banks.
Yeah, so you make a living trying to get people debt. Trying to get people.
Yeah, when you say it like that.
And how long have you been doing this for?
I guess 20 years.
All right, so how much debt have you got for people? Is that a statistic in your...
Hundreds of millions of dollars, Brent.
Yeah, okay.
Yeah. Well, I mean...
Single-handedly put Canadians in hundreds of millions of dollars of debt. Yeah. All right, welcome to the show.
Legally, it's not like Vinny on the corner, right?
Yeah, legally. I just had my epiphany moment. I got to get out of mortgages. No, it's been a crazy ride. The real estate, boom in Southern Ontario for the last 20 years has been an interesting ride. I never thought I'd get into mortgages. I hated math when I was in school. I used to say to my parents, my parents would say, why don't you go to math class? I'd say, I'm never going to have a career in math. It doesn't matter. I'm going to use my sales. I'm going to talk my way, through life. And here I am doing both, in a weird way. But yeah, it's fun. It's fun. It's a tough job because it's a lot of pressure when you're dealing with clients' mortgages. You're dealing with money. You're dealing with timelines. You're dealing with, financial documents. And for a lot of clients, that's an intimidating process. So we try to make it easy for people. We try to get the money in their hands so they can buy the assets.
I find it easy. I use a mortgage broker as well. Not you, sorry.
Yeah, that's okay.
But I'm just like, pushing the crumpled pile of receipts across the table and be like, here, you figure it out.
And that's exactly the...
And they come back and they're like, well... It's time for a financial colonoscopy. So give me more
smoking.
That's the good kind of client though, because that's what we want. In essence, it's like, give me everything. I'm going to send you a list of documents. Send me everything you have, and let me figure it out. Let me like a chef with a recipe. Send me all the ingredients, and I'll cook it up for you.
Yeah, and don't hide anything.
No.
Just tell me, because you do the translation between the client and the lender, whether that's the bank or whoever, right?
Yeah. A lot of unlocking the money at the bank is packaging the deal the right way to the bank. When the banks are trying to borrow money from, or when you as the applicant are trying to borrow money from the bank, they're really looking at three basic criteria that we as the applicant, we have to go 3 for 3. Otherwise, the bank will just decline us. That's how they work. Yeah. The 3 criteria when you're buying is very simple. Depending on the intention of the property, you have to have the minimum down payment, and it has to be coming from an acceptable source. That's a pretty easy one, because if you're starting out the home buying journey, that's an important question you need to know is, where am I getting the down payment from, and how much do I have? Yeah. When you're buying an owner-occupied, it's 5% down, and when you're buying a rental, it's 20% down. So that's a pretty easy one for most people to answer. Coming from an acceptable source is, checkings and savings, my investments, equity.
Do all the banks have different things that they say is an acceptable source?
They can.
Yeah.
Yes.
Okay.
And that's part of what makes dealing with the banks challenging at times, is they have different rules for acceptable down payment. Gifted down payment at some banks is allowable on rentals. Some banks will not allow gifted down payments on rentals. So little things like that can influence it. A bag of cash that I've been storing under my bed, not acceptable down payment. But borrowed funds off of a home equity line of credit, acceptable down payment. So down payment's a big one. Credit is the next one. If you want to borrow money from a bank, you have to have strong credit. So,
That's a credit score.
that's a credit score, right? The repayment history of your credit. So that's important. And then the third, and this can be more and more challenging the more properties you have, is debt servicing. And that's just income versus debt, where a bank will look at your income versus the debt and how they calculate that. Banks will calculate income and debt differently. So as you try, if you're a real estate investor and you're trying to grow your portfolio, you may get one answer from one bank that's a negative, and you may get a yes from a different bank just because of how they underwrite. So it's down payment, debt service, and credit. That's the three components that when you send me all of your documents, for the most part, that's what I'm trying to figure out, how to get your debt service in line.
So I'm self-employed, and that's just like a whole other world now, right? Like, do those three criteria still apply?
Yes, at the bank level, the banks are very black and white. So self-employed income, the banks just say, okay, you're self-employed, show us your tax income. Now, we know most of the time for self-employed people, we have a lot of write-offs. If we're sole proprietor, we're writing a lot of debt off. If we have a corporation, we're, for the most part, trying to live through the corporation and pay ourselves for tax sheltering, pay ourselves the minimum. So self-employed people traditionally may have a lower taxable income. And that to the bank will cause a problem with debt service, that third component. And if you have a problem with debt service, that's where the banks could, unless you're looking at like maybe a net worth program or something, that's when you're in the danger of getting declined because it's debt service. A self-employed person showing 30K of net income a year isn't going to qualify for much. Now, as an alternative to A lenders and banks, that's where we traditionally go for the best rate, the best pricing, it's the cheapest place to go to borrow money. If we don't fit inside their box, then we just move a tier to what's called B lending. And B lending is where they'll use a bit more common sense approach. They still want to look at your credit. Doesn't have to be as good as a bank wants. They still want acceptable down payment, though they may be a bit more lenient. And they use a more common sense approach when it comes to proving income. They'll look at bank statements. They'll look at money going into the corp rather than what you're paying yourself. So they just use a more common sense. Now that comes at a small price, it's not as cheap as the bank. Your interest rate might be 0.5 point to 1% higher. They charge a lender fee of 1% on the money you're borrowing in the first year. So it's a bit more expensive. But the trade-off for the self-employed person is they don't have to claim the income that a bank is going to want. So although they may be paying the extra fees with a B lender in rate and in lender fee, they're not paying the taxes that your traditional applicant is paying when they're qualifying through your T4 income at a bank.
Yeah, and I think that's tradition. That's what my wife and I have done for the past however long.
Yeah,
with a blender, as I call them.
Blender,
P-lender.
And yeah, you're exactly right. Right, we don't have the same taxable income, but the savings. You're saving much more on paying income tax versus the mortgage fees. So and it hasn't been. I don't think it's been as extreme as in terms of interest rate hikes as we've seen, like a lot of people who are on a variable or just regular homeowners where they've seen their payments double. Like ours have gone up, but not as extreme. It still hurts, but
it's funny because when 2019 was here and they started to drop interest rates when COVID hit in the middle of 2019, B lenders were pretty competitive. B lenders tend to stay about 0.5 point to 1% within the A lenders. So there was a time where A lenders might have been 1.99. If you remember, they got down that low, 1.79. It was crazy.
Just free money.
Right? And B lenders, 3.25%, 3%. And I remember I would have clients, and listen, I'm not trying to, pass judgment at all, but I would have clients that would call me and say, I'm not paying 3.25%, Dan. That rate's way too high when I could get 1.99 at an A lender. Yeah, but at an A lender, you have to qualify and you have to go through that, and you don't necessarily qualify. Well, I'm not paying that rate. And in hindsight, that's a rate that any of us would be more than happy to have. B lender rates today, you could be 7.5% on a 1 year, and that's A lenders 6.79 to 7%, so it's not a huge margin difference. They usually stay tight, but to your point, the fixed rates. Most B lenders don't have variable rates, except for one. They have a pretty good variable rate. They mostly stick to 1 to 2 year terms, because we, as the people in the B lender, we do want the option to maybe revisit leaving them every year to 2 years. If our income's going up, if our business is doing better and there's more income coming in, then we might get to the point where we want to leave the B lender and go to A lending. So it's nice to have a bit of flexibility with the 1 and the 2 year.
Yeah, which was interesting getting mortgage in the States. Trying to explain to them, like, no, I have a 1 year term.
Yeah.
Like, what do you mean 1 year term? Like,
That's different.
It's a 30-year AM, but the term, because they're all like 30-year terms, right?
A 30-year at like $299. That sounds real good right now. Real good.
They're not going to sell that house for a long time.
Yeah. So that's cool. What about, we talk a lot about young folks. Okay, I rag on young folks a lot on the podcast. And,
well, we also have their parents listening too, probably. So
yeah, that's true. No, but for young people trying to get a mortgage, let's say, youngish, maybe 22, 23. If I want to get a house, buy a house in a few years, assuming I can save up the money, like, what do I need to start thinking about?
Co-signers.
Okay.
That's the truth from Dan Patton.
It's the truth, because it's going to be very tough to solve the supply and demand issue. I don't see the supply and demand issue going away. When you look at immigration coming in, you look at the number of houses. It's simple. You can say anything you want about economics, but you just can't take away supply and demand. So prices likely aren't going to come down. Now, there'll be fluctuating times in a market where they go up and they come down more than others. But overall, I think real estate's just on an upward trajectory. So the problem right now for most people, for most young people, is two things. I mean, credit, like I said, it's the same criteria, right? Credit, down payment, and debt service. So credit, let's start there. If I'm a young person, I want to make sure that if I'm applying for a mortgage, that I have active credit, that I have strong credit, that I have... The banks say they have a guideline. They want 2 years on 2 trade lines. So 2 years, 2 trade lines of established credit.
And a trade line is
credit
like
card,
a
line of credit. Yeah, even a car. Cell phone bills do show up on credit bureaus now. They never used to, but the last 5 years, I think they started showing up.
Have you seen cell phone bills lately in Canada?
I know. Right? It's mortgages used to. When I first got into mortgages, no mortgages showed up on a credit bureau. Can you believe
really?
it? Yeah, they didn't show up. It was a big deal when they started showing up about 10 years ago. It was like, oh, that's going to start to affect people's ability to qualify. But yeah, it wasn't on there before. But credit, you want as a young person, you want to establish credit young, as early as you can, and which is kind of an oxymoron, because in some cases the young people say, well, I tried to apply, but I'm too young and they won't give me any credit cards. So what do I do? Well, there's secured credit cards that you can get, and a secured credit card is something that you prepay. You prepay $500 a month, or $500 for the year, and then you have $500 to spend, and as you use it, pay it back. It's a secured credit card. So there's ways to get credit. And that's one place you definitely want to start. Okay, it's not a necessity. If there's new to Canada people out there, you may not have a 2-year history. A bank will look at utility bills, cell phone bills in certain cases, but the guideline is 2 years of credit. So that's one thing. The second, down payment for young people. I mean, it's tough. I mean, how many 21 or 22-year-olds have 20% down to go buy?
Yeah.
Well, if it's their first-time home buyer,
5%.
Yeah.
So you led me right to where I was going. So we
Mark,
can
you
eliminate.
could be a mortgage broker.
Without mom and dad's help, you can, for the most part, eliminate 20% down from most 21 to 22-year-olds. So you're right. Now that they fall under the owner-occupied, I can buy at 5% down. Now, right now, when you're buying at 5 or 10% down, it's not the bank that's approving you. It's mortgage insurers that are approving you. The mortgage insurer is the company that insures the bank's money. We have a rule in Canada that if you're buying with less than 20% down, the money the bank is lending has to have insurance on it. That's what the government tells the bank. You have to have insurance. So the bank is not allowed to lend us money at less than 20% down without the insurer approval. So the insurer is the one that drives the guidelines at less than 20% down, not the bank. So the insurer right now, when you're qualifying to buy, based on where the qualifying rates are, and this might change, though maybe not a lot, if you're trying to buy at 5% down, you'll probably qualify to buy 4 to 4.5 times your income. So as a 21 to 22-year-old, when you start doing the math on income, 50 grand, let's say you're coming out of college, which would be a great starting income. If you're getting that 60 grand, if you're able to get that, you're going to qualify for maybe a $250,000, $300,000 purchase. And, maybe in other areas of Canada that's doable, but certainly in Southern Ontario, you're going to struggle.
It's a garden suite.
Right, yeah, it's a garden suite, right? You're going to struggle to find a property.
That's the construction of a garden suite without the land.
Yeah, exactly, right? So you're just stuck now, unfortunately, in this position of, I'm either going to need to add co-signers, and if you do the math, even if, I'm not sure how many kids are doing this anymore, but married at that young of an age, 20, 21 years old.
We know a lot.
There you go. So their combined income, of married couples can help. But even if you get to the $100,000, $120,000 range, now you're looking at, okay, well, if you're buying at $500,000 to $600,000, which maybe you can get in on an entry level condo, maybe somewhere in Golden Horseshoe, something like that. You're going to need on $600,000, you're going to need 5% on the first $500,000 because that's the rule. So $25,000 down. Then you need 10% down on the amount above $500,000.
Okay.
Right? So in this case, if it's $600,000, we can do $25,000 down plus $10,000 down on the additional amount. We have to have $35,000 down, and then we're going to have combined income of somewhere around $130,000 to $140,000 of income. So that's the challenges that young people face, and so inevitably a large segment of that will move into renting.
Yeah.
And then how do you break the cycle of renting?
So my thought is, okay, would it make sense for a young person to try and take a few years, save up more money, increase their incomes, or would it make more sense to try and find a cosigner or somebody to help them get a house now? Because we're kind of racing against the house prices increasing potentially, right? Like the risk is always there if you spend 3 or 4 years trying to build up a bigger down payment and get a raise or a promotion or a different job or something, and then get the income you're saying you need. You're like
chasing your own tail.
Yeah. So
early. I mean, if it's affordable, of course. I mean, that's the thing. When you're young, you want to make sure that if you're getting into something, that it's, they always say the term, you grow into a home. That's something my dad told me when I bought my first home.
How big is he?
Enormous.
Well, you'll grow.
Sorry to dance that.
But you'll grow into it. So buy something that you can afford, but that's at the higher level of what you can afford. Because as time goes on, especially in a time like this, if interest rates are set to come down, the cost of owning that home should become more affordable over time. We're in this unique time right now where there's the anticipation that rates will come down. So if you're able to buy now with rates coming down, there's a good chance in the next couple of years your rates will be low, or your cost of owning that home could be lower in terms of monthly payments.
Yeah.
And for most people that are working, their income will continue to increase, right, over the next few years, if they're fortunate enough.
Yeah. So fixer upper, like how far can you push that? Because at some point you need an appraisal, right?
You definitely
and the bank's going to be like, well, okay, there's no electricity here.
You can afford it, but it's not habitable.
The banks, that's the word. So the banks want it to be habitable, habitable, and in other words, 97% complete. That's the term that the banks want the appraisal to say the property is complete. So banks want your typical cookie cutter deal. In some cases, they'll do construction loans. They're tough to qualify for, but traditionally the banks want your cookie cutter single family, duplex, residential property that's ready to move in. They don't love the projects of construction. They want a lot of documentation for that stuff. Yeah. Now, granted, they can be the cheapest, but they can also be the most difficult to deal with. And a lot of the times when you're doing those flips, it's not always about pricing. It's about ease of transaction. I need the money quick. I don't need a lot of questions. I just need the money. I'm going to do this flip. I'm going to fix it up, and I'm going to sell it, or I'm going to refinance it down the road. So construction is not something the banks love doing, I would say. Most of the time those deals fall under private because one, the house is inhabitable or it's torn down too much, or two, the bank's just asking too many questions or you don't qualify, and that might lead you to private lending.
Yeah, well, that's where having a mortgage broker is going to be like, My mortgage broker has said the same thing, right? It's not all about the interest rate. Like that's important, but like, are you going to be able to requal? Are you going to be able to refi? Like
Requal, that's like the lingo, eh?
I don't want to brag, but I'm,
You're a veteran real estate
mortgage-
investor.
I don't know if that's a word. I just like throwing things out. Okay, what about, so let's say I want to buy a duplex. Can I count my projected income towards the mortgage payments?
Great.
So this my qualifying.
This can tie back into the first-time home buyer or the young folks trying to buy, trying to find ways to offset their income. The rule is, because some properties, you can buy it, you can live in it, and you can rent it out. So for young people, one of the ways to offset that debt, both in life and in qualifying, is to buy a property where they can rent out a unit. Now, the bank doesn't say, if you're renting out rooms, the bank doesn't count income on that. It has to be a separate, self-contained unit. So side door entry. Can you live in it? Does it have a kitchen? Does it have a bathroom? Does it have, in most cases, a bedroom? It can have just a regular den, but fully self-contained is how the bank defines it. So yes, they will count rental income
But it doesn't,
from that property.
does it or does it not need to be illegal?
Depends on the bank.
Okay.
Depends on the bank. Some banks say, yes, it has to be legal for us to account rental income, not to put a mortgage on it. If it's a non-legal duplex, they'll still put a mortgage on it. They just may not count rental income from that unit.
Right.
So depending on the bank. But some banks, they just say as long as it's self-contained, we will count it.
Yeah, because that is a reason why a lot of people will legalize. It's one of the reasons, right?
Yeah.
Like, it's nice to have something legal, of course, but one of the reasons is you're going to get financing or a lot easier, more options.
Yeah.
So,
well, and you're right. It's a lot of times people want to legalize it because it adds value to the property. Just legalizing it adds value. When they're non-legal duplexes, there's a bit more risk. You still have to make sure that as the homeowner, you have exit points. You're a good landlord. You monitor it like it's legal. You have to, but more risk on a non-legal, of course.
Okay, sorry, I'm just looking at.
are we recording?
Yeah, I think we're good.
Okay.
Start now.
I have a question that might be totally shifting, but are interest rates coming down? Because you alluded to that. But everybody who's listening is like, Dan, what are the rates doing?
Predictions. It's.
Did you bring your crystal ball? Or?
I don't have it here. I left it in the car. You want to run into that? Just take off and I don't come back to answer the question. I think inevitably, I think rates will have to come down. How fast and how quick is another story. I don't.
Well, you see this with a different perspective than us. Like, we're just average Joe real estate investors. Like, you're kind of on the other side with the banks talking about interest rates all the time.
Yeah, I guess, on some level, I think that, it's interesting because the first thing I sort of always said, for the market shift to happen, because right now the market's slow. It's still slow. It might be picking up, but there's still, it's certainly not as busy as it was the last few years, and I don't think it's back to how it was before. But it's much slower than what it was before. What was the question again? I just lost.
Like, our interest rates coming down.
Yeah, interest rates coming down.
It's a bit speculative, but it's an interesting conversation.
So
why would they? What forces are at play?
Well, what forces are at play is we're trying to keep inflation under control. Okay, the cost of goods is getting out of hand and people are spending too much. Now, why they're doing that has been called into question when COVID hit and we lowered interest rates so much and we gave money, which again, there's a term that they call triage on the battlefield. And it's hard to criticize the answers the government did in the middle of the battle. Okay, they tried to lower rates and keep the costs cheaper, and they tried to give business owners money, although they shut their businesses down, but they tried to do what they had to do. Now, what ended up happening is when you give people money, they spend it. And that's what the government wanted. They said, listen, we are facing a potential economic crash. We are going to hemorrhage that by lowering rates and printing money so that people can keep their businesses going and they can continue to spend. And that causes inflation, which is, as we know, the cost of goods, to get out of control. We normally hover around a 2% inflation rate. That's the rate that they tell us. We want to be at that. It means our economy is growing. Inflation is good on the level that it just shows the economy is growing. For the most part, wages are increasing and your economy is growing. But supply and demand comes in and things become more expensive. There was trade rules that were done that caused the prices to go up, but people were spending and inflation got out of control. So how do you stop people from spending money, right? How do you stop that bleeding? You have to increase interest rates, and that's what they've been telling us.
Make money more expensive for people.
Make money more expensive. Drive up the cost of mortgages. The cost of goods. The sad thing about inflation is it's not like the prices come back to where they were before. They just stop going up at the rate they were going up. So we never get that back.
We had to repeat that because that's big for people.
Okay, so inflation, it's not like the prices will come back down to where they were pre-inflation. They'll just stop going up at the insane rate that they were.
Right.
And we peaked, I think it was 8.2% last year. That's where inflation peaked. So, to counter that, you have to, as an economy, we walk a fine line. We lived for the middle class. The middle class is what drives our economy. That's who goes to restaurants. That's who's getting mortgages. That's who works the jobs and sells the car and does all the other things that run the world. It's not the rich and it's not the poor necessarily. It's the middle class. So we have to maintain the middle class. We have to. So you drive up. In hindsight, it's not a bad strategy. Okay, now I know that that's going to affect a lot of people when you're buying or when you're jacking up interest rates like that. It's going to affect a lot of people with variable rate, but you've also got a large segment of people who are protected by that, right? You have people that are in fixed rates who maybe aren't feeling the pain of an interest rate increase right away. So raising interest rates should start to curb inflation. It should slow down the Canadian spending and bring that CPI number back down to what they've told us is 2%. Now, again, you can argue they did it too fast. They raised rates too fast and too quickly. But that 8.2% inflation rate is insanely alarming. They had to stop it. People would say, well, they should have done it earlier. Okay, well, maybe, but they didn't. And these are the circumstances we have. So what you've seen now, the first year, what was it, like 7 increases or something like that? I wish I had something like that. Like it went up so violently and so fast.
It was pretty painful.
It was insanely painful, especially for people that had
debt,
variable rate mortgages where the payments changed, or HELOCs that had debt, because those were the people that were initially affected. So what did we see? What were the results of that? We started to see inflation start to come down. People got scared. Holy cow, rates have gone up. I better stop spending. You affected a large segment of people, but you didn't affect all homeowners,
right?
Because you had people in fixed rates who they're not affected. Their rates haven't changed. You have people that don't have HELOCs. You have people that had a variable rate where the payments weren't changing. So it takes time. The point is it takes time for these changes to cycle into the economy. It doesn't happen overnight. It doesn't happen over a month. It takes a year, 2 years for these changes to cycle into the economy. Because inevitably the people with fixed rates, they renew. And when they renew, they have to take today's rates. Same thing with the variable rate people where their payments aren't changing. Mm-hmm. They may have a 70-year amortization right now, because if the bank's not changing your payment, all they're doing is changing. If you're paying principal and interest, the bank's just increasing the interest and decreasing the principal. And some people, so much so that they're not even covering the interest anymore. And they're going to come up for renewal. So you see there's this avalanche building of people that maybe haven't been affected yet, that are going every day. More and more Canadians are being affected. So you're starting to see it. You're starting to see layoffs. You're starting to see, it's funny because unemployment is sort of a interesting number to study. We look at, if people are spending less, then you would think unemployment's going to go up. And that's a potential sign you have to be careful of.
The Phillips curve. Right. We talked about it. Dan, can we pause for just a moment? Yeah. And we'll be right back, folks.
Man, that was something so interesting that you said. Yeah.
Okay, we are back after the break, folks. And Gideon, you can either edit this out or leave it in. But we're back. So, Dan, we were talking about
an avalanche.
Inflation, rate renewals, an avalanche, as it were, of rate renewals coming up.
Right.
I mean, in Canada, we're generally 5-year terms. So would it be roughly 20% of mortgages renew every year? Is that fair to say?
Yeah, I would say so. If you're, that's every 5 years.
Of fixed, anyways. Yeah.
Now, it's a bit different now. It's pricing-wise today. And I'll go back because I want to make sure that I make the point about the inflation, because the question was
rates coming down.
So I'll go, if it's okay, maybe I can answer that one first. So we're starting to see the effects of interest rates being so high for so long, okay? And you're seeing inflation come down. I think last print was this week and it was 2.8%, lower than expected. And people believe that it's really only that high now because of the cost of mortgages and gas is still high. So you could argue that we have inflation under control, but we're not seeing the break in rates yet, because if you lower rates too quick and you make money cheap for people again, what will people do?
Spend money. Well, they'll get more credit.
They'll get more credit and they'll spend their money and they'll spend money, and that's what happens. And you can't have people doing that in a time where you're trying to control inflation. You can't have this up and down, because this up and down of rates come down, then spending goes up, rates go up, then you have to bring rate. You can't have that, because that inevitably is what destroys the middle class. You end up separating the rich from the poor and two classes of people in the economy, and you just can't have that. So we walk this tightrope now of trying to control spending, inflation, and we do that with rates. We did that when COVID happened and we were worried that the economy was going to crash. We lowered costs to keep the economy going. And now that we're in fear that spending is getting too out of hand, we increase rates to drop that. So I think, yes, to answer the question, I think inevitably rates will have to come down. We're starting to already see fixed rates have started to come down. Now, not everybody knows the fixed rates are different than variable. The Bank of Canada is what drives the variable rate. And that's just, the government telling us what prime rate's going to be. That's a group of people deciding.
They're pretty smart people, though.
Pretty smart people, for sure.
PhDs and stuff.
Yes, smarter than me, for sure. But they are there to determine what prime rate is and the overnight lending rate. Now, prime rate today is 7.2%. I think in the peak of COVID, it was down to like 2.45.
Don't remind me of the pain.
And it's at 7.2%. So that's a number that how we control the variable rate. Now, fixed rates are based on the bond yields at the bank. The greater the bond yield, the greater the rate. So it's different pricing. Now, they're not directly tied together, but fixed rates are more sensitive. Fixed rates will move on speculation. They'll move on rumor. They'll move on sentiment. So you'll see fixed rates move more frequently. Fixed rates have started to come down, gone up a little bit. They might be coming down a little bit more. You don't hear that in the media as much as you hear the Bank of Canada's prime rate.
Yeah.
But eventually, prime rate will have to come down. No question about it. How fast and how quick, that's anybody's guess. I would like to think a quarter point to half a point this year on the variable rate. I'd like to hope. I don't think that'll happen till the summer or the fall. I don't think we'll see any changes. But what's important is sentiment is starting to change. Us as consumers are no longer going, when are rates going to stop going up? The question is, well, when are rates going to come down now? So we're starting to see the sentiment of the consumer shift. And that's important if we're trying to buy a home or if we're homeowners, because a shift in sentiment leads to, when rates potentially come down, the market getting busier again.
Yeah.
Because that's building. The buyers are building.
Such a game.
That's been such an interesting part of watching the Fed and like Bank of Canada too, but really who cares about the Bank of Canada? Sorry, Tiff. No, but how they're not, it's not just about managing rates, it's about managing sentiment.
Yeah.
So I don't know if you follow my buddy Jay Powell down in the States there, Jerome Powell, right? But his latest speech was very, I guess you would call it dovish, right? No cuts yet, but he's like, they're coming, people. Do you think the Bank of Canada would break with the Fed, potentially, if we had some bad news here?
Yeah, I think anything's possible. I think that it's all about inflation. And listen, I think that it's interesting with an election year. I think that's a really interesting thing to watch, because if I'm the incumbent president and I want votes, I would think that dropping interest rates would potentially garner more votes. I could say that I've fixed the economy. It's on its way. Like, look what I've done. So I think that there's some political influence.
I thought they were independent, man.
They are. But I think that's an interesting thing. Now, we're not directly tied to the U.S., but to your point, we typically follow them. I think we're like a quarter point behind them. I think we are, but we're within a quarter point of the U.S. But I think more likely you see U.S. drops this year, and then that lines up pretty good with the 2025 Canadian election.
I always thought it was like the U.S. is calling up Canada to say, you got to do this as a little bit of a test to see how it's going to go.
One state that you can run a little test pattern.
Yeah, basically.
But I mean, we're so much more dependent on real estate in Canada than the States. It's a different...
It's a completely different animal.
Different market.
You're right. And our real estate markets are narrowed down to a couple of cities. In the U.S., there's 30, 20, 30 big cities. There's like 5 just surrounding the state of Texas. You can think of 5 alone that are big enough to support real estate investing. But you're right. For the most part in Canada, it's centralized to Ontario, BC, maybe Alberta. It drives the bulk of our economy, real estate.
Yeah.
Definitely.
Yeah, which is, it's a whole other problem.
Yeah.
But, okay, so I'm trying to pin you down, and you're being pretty wily, like, interest, I don't know, maybe we'll, what's your prediction?
But they're coming down. They're coming down, he said, right?
They're coming down. I think quarter
it's not
to
if, it's when. Yeah.
Would you go in on like a fantasy Bank of Canada interest rate league?
No handicap, straight odds? Sure. I feel like I have an advantage potentially. Why not? Why not? I'd be in for that.
All pool our money and, whoever's got the closest bet wins.
Yeah.
I mean, we talk a lot about inflation and we hate the idea of inflation and how it's calculated and everything to do with central banking, but that's another...
Well, your comments about the middle class and how critical it is for our country, right, to survive, and then you've probably seen over your career how it's kind of been gutted, right, or it's being gutted.
Yeah, it's, I think that we're certainly a long ways away from, Venezuela, where the poverty rate's like almost 50%. You have this insane migrant crisis that's going on, unfortunate. We're a long way away from there, but to say we're not headed for something like that, that's up for debate, I'm not saying we are, but if things don't improve when it comes to housing, we have great immigration policies, we really do, and we love immigration. Immigration is what helps grow the economy. We're picking from the best, in a lot of cases, the best from other countries, but we need houses. If you're going to take in that much immigration, you need to build houses, because if you don't build enough houses, what do you do as a landlord? If you're a landlord and your costs go up, what do you do?
Pass on the costs.
You pass on the costs. So the rent goes up. So the cost of living is inevitably a problem. How do you unwind that? I mean, how do you unwind that? The simple answer is you build more houses. But there's so many restrictions, there's so much red tape on doing that. And again, I'm not trying to simplify them. It's take a lot smarter people to figure this out than me. But, it seems like build more houses. It just seems like such a, you know what I mean?
Or what are we doing talking about it? We should go out and build
some. The government is building lots of affordable housing.
Yeah, I've heard that too. But it's not enough to support the immigration that's coming in, and the Canadians, the young
it's
Canadians.
Like, where are they getting the money to build that stuff too?
People like me,
making it out of thin air.
Yeah.
Oh, now we've talked about this quite a bit as well, and I mean, talked is maybe a soft word. Just about GDP and how we need immigrants to keep the country going. Like, that's the argument, right? We have to get GDP up. Well, real GDP has fallen.
Or like GDP per capita, right?
Yeah, that's what I mean, per capita. It's dropping. Millions of people.
Mark's going to start another rant.
Yeah, sorry, I go off on the rants.
But the printed number is different, though. So you're right, because some people would say we're already in the recession. We're already in it. But other people would argue, well, not technically, because GDP, I don't think it shrunk last time, did it? I know it did for 2 consecutive quarters.
Nominal GDP is going up a little bit, I think. Right. But actual, like per capita, we're dropping like a rock.
Yeah.
Like a rock.
Yeah.
I feel like Kramer.
But yet unemployment is somehow staying neutral.
Well, because we're in fiscal dominance now. So like we've talked about the Phillips curve on the show as well, right? The relationship between employment and inflation,
Yep.
and how that's always inverse. And now it's like it's broken.
Yep.
And so what do we do now? So, anyways,
A lot of government jobs. A lot of government jobs being added.
Yeah, I saw the latest numbers.
It's like 10 times the private sector or something crazy like that.
Yeah, but even just the latest numbers, like, employment's up. And it's like, wait, like, I think there's 80,000 more government sector jobs. We had maybe, I don't know, something like 20,000 fewer private sector, and then a whole bunch of self-employed. And like, when you look at it, it's all like Uber and Lyft and stuff like that, right? Which, like, nothing wrong with that. It's employment, but it's not, I don't know, if you have an advanced economy, so to speak, that we kind of pride ourselves on. Like, I don't think we have that anymore. We have a government.
Not going to be a serious boost to your GDP.
Yeah, and then how do you measure GDP when it's all government spending? Like, I know it's part of it, but when it's the majority of it. Anyways, don't get me started, Dan. Start throwing my pen across the room. So we've talked about kids in the market. Oh, one thing I wanted to talk about. Dan, can you get me a promissory note?
No. Yeah, promissory notes. That's an interesting topic for sure.
So I don't know if I'm just dumb. Like, we're both in real estate and, haven't been for like as long as you, but I had never really heard of promissory notes in the context of real estate. I've heard of them in other contexts, but until very recently. So, like, is it just a new thing? Or, did I never hear of it and they always existed?
You probably just didn't hear of it. They always existed. But as a mortgage agent, like myself, it's not something that I would ever entertain, and it's not something that I would ever suggest an investor entertains because of the risk. The difference is, so I'll explain quickly what a promissory note is. A promissory note is basically a loan. So if I wanted to borrow money from, say, Brent, and I promise to pay him back, I might sign some paperwork to pay you back, and you give me the money and I promise to pay you back. That's a promissory note. There's no security.
And if you don't, you say sorry. Sorry.
I'm up to be sued. I'm up to be sued. You could sue me, but there's no security. Yeah. That's the problem. So as a mortgage agent like myself, I've been doing private lending for years, and I like lending people money. I like the business of that. It's a good business. You lend it to people doing flips, construction, lend it to people who are maybe doing debt consolidation. There can be some value in lending money to people. Now, the problem is, of course, is no matter how much, you like to believe and trust in people, things happen in their life. Circumstances happen, and in some cases, they're not able to pay back the loan. Yep. So when people aren't able to pay back the loan, in our business of mortgages, of registering secured loans, we want to be able to take that asset and sell it to get the money back for the investor. And that, in essence, is what a mortgage broker would do to lend a client's money privately. If I'm a responsible private mortgage lender, I've taken they just had a new course come out that you had to pass to get it, so I'm fully licensed now.
Oh, you guys got to take courses now?
Yeah, now you do. Yeah. Oh man, before, that's a good point. When I first got into mortgages, all you had to do was have your license a year after you did your first deal. So there was a whole year where you didn't know anything really, you didn't have to be licensed. You had like carte blanche. And I did mine under my old business partner's name, so I had like 2-3 years of just cruising with no education. But we're back on, right? Yeah. So I am fully licensed, but that in essence, that a mortgage broker will assess the risk of loans for you, the private lender. And with promissory notes, there's no security. That's it. So the problem is, if the people don't pay you, that money is gone. And you're seeing that in some cases now.
Like the guy who lent the money has no recourse.
The person, the lender who loaned the money, has no tangible assets to force the client to be in a position where they have to sell that asset to get you your money. I recently took possession of a private mortgage that went bad. I had a private mortgage with a client. 4 or 5 years, I think I had it with them. And for whatever reason, the client, circumstances come, the client doesn't pay. So what do you do? Well, this is a scary proposition as the lender. First thing I have to analyze is, what's my risk here? What's the mortgage balance that this client owes me versus the value of the home? Okay, because I now need, if he's not paying me, because I have this security, I can come in and force them to sell their house. But I need to wait for the courts to process this. This is called power of sale, where I am granted possession of the home and control of it to sell. So for 6 months, almost a year, we're waiting for the courts to award us possession. So inevitably, they award us possession now. Possession doesn't mean ownership. So it's not like if I sell it at $1 million, I keep all the profit. It's not the case. The profit goes to the owner of the home. But I am now granted.
Oh, really?
Yeah, I am granted possession of the home,
Okay.
so I can sell it at fair market value to get my money back.
Yeah.
That is security. Now, the broker, again, this is a type of loan where we were in first position. We had a first position mortgage, somewhere around $500,000. The property was in Burlington, beautiful property, right on, nice exposed street, close to a school. The houses in that area are selling for $1 million.
Yeah.
So you'd say, okay, well, great, Dan, that's awesome. $500,000 home, or mortgage, $1 million home. Well, who cares? You sell it for $800,000, you're going to get your money back. Okay, well, what if the guy is a hoarder, which he was? Okay, hoarder house. So, place is absolutely destroyed. Okay, you're talking unlivable.
Yeah,
If you walked
yeah.
in there, or you walked in there, it's unlivable. So, do you think that property? I got that property appraised at $1 million 3 years ago. You think that property is worth $1 million anymore? No chance. Not only did he destroy the property from the inside, but he also was an amateur landscaper. Dug up all the property around, sloped, leaking into the neighbors, yard. There's city, orders against the property. It has a grow up thing from 2015 from being.
I want to see
up.
this house. Can we go after?
Yeah, well, the good news is I sold it, and we can definitely go see it. But it's funny because inevitably it's completely gutted. So my point is the risk accelerates because remember, not only I owed him he owed us $500,000 from the beginning, but what do you think happens when he stops making payments? He owes us more money. So that $500 can turn into when you have to pay a lawyer, power of sale lawyer. I can't go into the court and say, give me possession. I need a lawyer to do that. Well, a lawyer's $20,000-$30,000 for something. Lawyers aren't cheap for power of sale. The lawyer has to hire a company to come in and take everything out of the property, like a property management company. There's NSF fees. If the client had a mortgage with the bank and he's behind on the bank more, it starts to add up. So your risk might have been here, and now it's just starting to shrink, and you have less and less margin. So inevitably, we ended up selling it recently. I put it on the market. It was on the market for about a week. I mean, we want to do our diligence. We don't want to burn the seller. We want to put it on the market, get him fair value for the house, and that's what we did. It sold for, I think, $735. From $1 million appraisal in Burlington, $735.
Wow.
So when you're lending, I am always as a broker looking at the risk and how, in a worst case scenario, how are we getting our money back? Because that is the root of private lending. How am I getting my money back? And to go back to the promissory notes, there is no security. There's nothing.
Yeah.
You're waiting for it.
So in that same situation, let's say you had a promissory note.
Yep.
What would be the play out of that? Like, you can't force the guy to sell. You can't get the.
You'd have to go through the lawyers and go through like a small claims or like the court process that way.
And you can't, but you still can't force him to sell it.
No.
So you can't really get anything out of him.
No. It's a promissory note is like, if I gave you a letter, Mark, and I said, okay, I'm going to lend you this money as a promissory note. You're going to sign this, and if you don't pay me, I'm going to convert this loan into a mortgage. That's what's going to happen. So the borrower might think, oh man, I better pay her. I'm going to have to convert this to a mortgage. Convert it to a mortgage. So you know what that means? If you don't pay me, you got to sign this now, because now I'm going to register a mortgage. So you got to sign the paperwork to make it a mortgage.
I don't think I'll sign.
Exactly. So now I have to chase the person to get the security. And if the person's not paying you, what are the chances they're going to sign the paperwork to allow you to secure the loan?
Yeah.
So it's this cat and mouse game of, will I get my money back? Yeah, maybe down the road, because the client did sign the promissory note and if there's equity left in the home. But remember, your equity doesn't take any claim over the legal fees, the property management fees. I learned this. When you take possession of a vacant property.
I'm gonna ask how much you paid to learn this.
Well, this is the thing. All the costs come out of the sale of the home. I'm the lender.
Yeah.
So if I have to go and get snap insurance on a vacant property that nobody will insure, that's not cheap. That's $3,500 for insurance for 6 months on a vacant property. And vacant property insurance doesn't cover water damage. That's the way I learned that.
Yeah.
It covers everything else. Somebody can come in, light a fire, it goes up, I'm covered. But if somebody comes in and turns the taps on and it floods, you're not covered. So the first thing you have to do when you take possession or something like that is you got to get the water shut off. Yeah. You have to get the water shut off immediately because you're not covered. So, and that costs money. So you see the costs keep adding up to the client. Yeah. We were there the other day. I had to put a fence around the property, like a construction fence. In the insurance, I have to have a property manager. I have to have site inspections every 3 days to keep
3 days.
Yeah, every 3 days. Wow. And that's a fee. I mean, it's not. I mean, but so it adds up. It keeps adding. So your risk just keeps getting greater and greater.
Which is interesting because when I think about like private lending, I always think hands off. Like you're never going there. It's just here's some money. I'll collect the interest. Yeah,
it's easy money.
It can be,
but it's just kind of like you sit at your desk, you type in some numbers in your computer, and you get paid every month, whatever, right? But you're saying like it could be a situation. Where you're going down there setting up construction fence.
Yeah, because you're exactly right. I mean, who else is going to do it?
Yeah.
I learned, believe it or not, I've never had a power of sale in my entire career of lending mortgages. Never had a client. So for the most part, you're right. Lending money to clients from a lender standpoint, if Brent or Mark were going to be a private lender with me, it would be relatively easy in the sense that I do a lot of I would encourage anybody to learn private lending. Ultimately, it's your money. You need to learn how to lend your money. You need to learn how to assess risk, and you need to work with professionals. But it's your money. So you have to learn how to gauge risk. But the process can be simple. I have many clients that maybe they're trying to do renos, or maybe they lost their job and they're looking to consolidate $100,000 in debt because they can't afford the monthly payments right now. They have a good mortgage with Scotia or a bank or RBC, something like that. They don't want to break that mortgage. So what do? They have a house that's worth $1 million. They have $400,000 mortgage on it, and they're looking to borrow to get rid of all this debt that they accumulated during COVID. Well, that might be, the kind of loan where you loan the money for a year. In a year from now, we always want to think of the exit strategy. If I'm lending this client money, how am I getting that money back? Our worst case is we're going to take possession and we're going to sell it. That has to be our worst case, and we have to understand what our loan to value is. But again, if I have a good client and they're saying, well, Dan, I need this for a year. I'm applying for a new job. I can't qualify anywhere right now because I'm laid off, unfortunate circumstance, my partner's sick, whatever it is, we're not working, but we're going to be back to work in a year. This is temporary fix. We're going to qualify in a year. I might come to you and say, listen, this is the loan. This is the circumstance of the client. As long as they're employed, making X amount of dollars in a year, I can refinance them, pay out your loan, get them back to a bank, and get them back on track. Okay, that has happened. That's happens a lot. But if the client doesn't pay, you have to know your exit, and that's what can happen. If they don't, that we have this great plan of they're going to have income, they're going to have employment, their credit's going to get better, and we're going to qualify them in a year. But if they don't, the responsibility is on them. I, as the broker, have to get your money back, and that's when you have to look at selling the asset.
So you brought this up kind of in the context of that story, right? In the news, with these big guys going under.
Yeah. Okay, first, I just want to know. Okay, so in your private lender, even the bank, right?
Yep.
Like the banks don't want to take your house, but if they do, so let's say you make the sale. And let's say there's $100,000 left over. Who gets that money? Like all your lending costs have been satisfied.
Yep.
And plus all your lawyer, et cetera, et cetera. And there's a little bit left over. Who gets that?
The owner.
Okay, so it's not like you got the house and...
Correct. Right. I thought that, originally I thought, does that happen? But no, it doesn't. What happens is there's a distinct difference between ownership and possession.
Right.
So I am granted legal possession of the property. He's been evicted, but he is now he's still the homeowner. And as the homeowner, he is entitled to whatever proceeds are left after the costs are, covered.
Okay, so that's another, that puts a different, because I always thought essentially you get ownership. of the home, and then okay, so they haven't paid for a while, but the property value's gone up, so I'm actually better.
Yeah, there's.
But you're not.
This is where private lending can be, again, depending on the lender, you could come in. I mean, the courts may not like it, but there's ways that you can come in and buy that house yourself. I mean, I have control of that property.
Oh, okay.
So I could sell it for whatever I want, to whoever I want. But you can't do that as a broker. You have an obligation, you have a fiduciary duty to the client, this is a client I loan money to the borrower, to sell it at market value, to take the right steps. This is why I don't just put it on the market and sell it to the first buyer. We get an appraisal done first from a company. So I understand what an appraiser says the minimum value is going to be to sell that property. That's where my starting point. Then, as a realtor would do, you put it on the market. In a market like this, on a house like that, I thought it made a lot of sense to hold offers, put it on the market at a discounted price and wait to hold offers, while at the same time willing to accept offers. Mm-hmm. So that's what happened. I mean, we put it on, we got a couple lowball offers, a couple good offers with conditions, and then one that was pretty close to the high side that had no conditions. And to me, as the seller, there's a lot of risk. This particular property, if we're going back to this one, in my position, had a ton of risk on it. It had outstanding issues with the city with a marijuana grow up, which marijuana is legal now, but if you have an outstanding charge from the city, you got to figure out how to get that undone. Maybe it's having a mold inspector coming in and getting some certificate, but you got to research how to do that, because the buyer, if they're putting that as a condition, you got to clear that. This house, again, you could have pushed the windows and the windows would fall in and you could just walk into the house. So anybody could have come in, water damage, things. From a lender perspective, I also have the right to come in and sell it quickly to get my money back, as long as I'm doing it in a responsible way for the owner of the home. We always, regardless, circumstances happen. I don't know the owner personally, but we want to try to maximize their value. But that's the dark side of private lending is, in some cases you end up having to take possession of somebody's home, and that's not for everybody. When my parents private lending for years, it's a bank of mom and dad's a great place to go to.
Those are promissory notes.
I promise, exactly. But my mom said, Dan, I don't want to be a private lender because I don't want to kick a family out on Christmas. And I understand that.
Yeah.
I completely get that. But that's the game you're in as a private lender. It's business. And you have to understand these people are entering into a legal contract. They understand the loan. They understand the risk. They understand that if it's not paid back, it's your house at the same time. That's not fair to you as an investor or you as an investor to not get your money back because you feel bad that they didn't, that you have to kick them out. So that is something, unfortunately, that you have to understand is part of the process of private lending. It can go down that far. And when it does, it's unfortunate. You just want to make sure you take care of the seller as best you can and that you get the investor's money back. And that's the best case scenario for everybody.
But that's not unique to private lending, right? The bank will go through the same process if you don't pay them.
So. That's the same thing. That's the exact same thing a bank does, exactly, when they take possession. And they don't keep the profits either. The same thing. They take possession and sell it and the proceeds go. But to your point I don't know if you wanted to talk about the promissory notes more, but that's...
I want to talk about, you mentioned fiduciary duty. So what does that look like for, just briefly, for a mortgage broker? I don't know. What do you think that means?
Well, we have
what does it mean?
We have a legal obligation to ethically act and behave a certain way with investors and borrowers. And that's important. Not everybody does that in every business. Listen, I think everybody should be operating on some sort of code of ethics, but it doesn't always happen. So a fiduciary duty basically just represents that you have a duty, a legal and binding duty to be honest and upfront with the clients, the borrowers, the lenders, inform them of the risk.
That doesn't mean that promissory notes are off the table. Because this whole situation you just described in Burlington with this house, that was not a promissory note. That was a private lending scenario where you actually did have security of the house,
we had all
right?
the security.
So you had that all in place, and the client ended up being okay, right? But it's not the best way you want this whole thing to go.
Well,
but a promissory note would have gone a lot different.
Well, without getting into any names or anything, because listen, until everything shakes out, we don't really know what happened. But you can see one of the risks of promissory notes. Okay, so there's a mortgage company out there that worked a lot with investors. If you were in the circle of investors, if you worked, closely with different investment companies, you probably saw this company. You probably saw their name. They promoted themselves as big investment. They promoted themselves as private lending experts. They were put on stages. They were put in front of, regular investors. And, you made a good point a couple minutes ago, Brent, when you said most investors, they just lend the money and they want to forget about it. So most investors aren't, and for, understandably, they're not as trained as maybe somebody like myself or maybe people like yourselves who've been doing it for a while. So most investors, they look to people maybe like myself or other mortgage brokers for advice on things like this. We're a trusted source. We're supposed to be ethically responsible, and we're supposed to work within regulated, we're mortgage brokers. We're not promissory note brokers. We're mortgage agents. And mortgage agents, a mortgage is a registered charge, right? So when this mortgage agent was promoting a system, along with realtors and property management companies, were promoting a system where they were going to buy houses in places like the Sault Ste. Marie, and they were going to take $250,000 houses, and they were going to renovate them. They were going to put in however much, 100 grand, whatever it was, 150 grand, and these properties were going to be worth $400,000 in the end. And when the properties were worth $400,000, they were going to refinance and they were going to pay all the investors back their money. Okay, sounds like a good plan, right? If I'm secured in real estate, so let's think about that. Okay, if I'm buying a house for 250 grand and I come to Mark and Brent and I go, okay, well, you guys are investors. This is the project I'm doing. I'm going to do this 250 grand purchase. So what I'd like to do is I'm going to borrow 80% of the purchase price of this home from Brent. You're going to give me 80%. You're going to be in first position. So let's use this for my head. Let's use easy numbers. Let's say it's a $300,000 purchase. Okay. So you're going to be lending 240 grand on this property.
Hey, you said you were no good at math.
That's why I jumped from 250 to 300. Those 50s get me. But 300,000. So you're going to give me 80% of that. That's 240 grand. Okay. Now you're in first position, so your risk is really the lowest, because if they don't pay, I'm going to sell this house. It's worth 300 today. You owe 240 after real estate fees. You see how thin my numbers, my margins are after I pay costs. I should have enough to pay you back, but 80%.
But I get first.
That's why it's 80%.
That's
right?
why
I get first dibs.
You get first dibs. You're in first position. 80%. You're exactly right. Is traditionally the highest risk any private lender would do. You wouldn't do 85, you wouldn't do 90, but you would do 80. And in this market, it's arguable whether you'd even do 80. I'm not doing 80 right now.
Oh, no?
No. Especially in a small city like that. I don't want to be overexposed because I see how quickly the market can shift. Values come down. That $1 million home's not worth $1 million anymore. It might be worth 900.
Is that usually why the appraisals come back lower than what the actual sale
it's
probably
a market shift. So what happens is, you're now on the hook, okay? Let's say you're going to make on your money, I'm promising you 8 to 9% interest rate. I'm going to promise you a 2% lender fee, okay? You go, that's a pretty good loan. I'm going to do that, Dan. I'm good. You're in first position. Okay. Then I'm going to turn to Mark and I'm going to go, Mark, you look like the kind of guy that wants to invest in a bit more risk. You want to make a little bit more money? Okay. So what I'm going to do is you're going to lend me the down payment. So if he's borrowed to 80%, I'm going to borrow 20% from you. Now your risk is at 100% of the value of that home. If that home's worth 300,000, Brent's got 240, you've got 60 in there. So if that house doesn't go up in value, if it drops, you're in big trouble.
He gets his money back, probably.
Probably, but you're in big trouble now, because remember, when you take possession from a property, it's because they haven't it's because they haven't paid you. And if they haven't paid you, then his 240 isn't 240, it's 241, 242, every month. There's NSF fees. So his exposure starts to invade on yours, right? And if that property comes down, you're at big risk now. So I don't mean to point at you, my apologies.
Point away. Do we have to tell Brent that we're doing this?
Yeah, Brent would get notified. But it doesn't, to Brent, it doesn't really matter.
But Brent's in it for a private mortgage. That's what it's called.
Yeah,
What's he in it?
Private mortgage. You're both
Private mortgage,
secured.
first position,
Yep.
second position.
You are less risk because you're in first position secured.
All right.
You control the sale. You're
Right.
in first position. You're just now hoping to get your money back. That's it. Please, somebody get me my money back. I hope values continue.
Mark,
to go
you're
up.
foolish.
Now, if you
You're not the first one to say that, Brent.
if you're not at high enough risk already, remember I said I was going to do renos to this property?
Yeah, you have cash for that, though, right?
Why get cash when I can borrow it off of Gideon?
Yeah.
For and even higher. Remember, you're at 899. That's your rate with
Yeah.
a 2% fee. Because you're at 100%, you're making 12%.
Hey!
With 2%, easy money, right? So now I go to Gideon and I go, look, Gideon, I know these guys in the Sioux. Okay. Now, unbeknownst to, I don't know what was said here, but imagine I also own the construction company. I go to Gideon, I say, Gideon, I'm going to need to fund this reno now. Okay, because I got to get this house up to 400,000. That's my investor. That's what I've sold the investors. You were going to do this. We're going to do it. So I say, but Gideon, there's no equity in the home anymore. Brent's at 80%. Mark's at the other 20. We're at 100%. So listen, you're the riskiest. Why don't you give me 60 grand, 100 grand to cover the renos? I'm going to do this promissory note, and remember, when the renos are done, this $300,000 property is going to be worth $500,000.
Yeah.
So when it's worth $500,000, if I want to refinance it and pull the money out, I'll have enough to pay Brent, I'll have enough to pay Mark, and I'll have enough to pay Gideon. So Gideon, you want to lend it to me? 15% on your money.
Ooh,
2%
15%.
lender fee. 17% on your money. And it's 6 months. So you're talking like over 35% on your money annually, ROI. Pretty good, right? Now, again, you're just a promissory note, but,
You're a good
we
guy.
got a good track record.
Yeah.
Look at the history of this. Of this
We did it
project.
last month. We
Did it last month. We've done this over and over again.
Now, is that promissory note, is that going on this house specifically?
Yeah, there's a note that's promised that if we can't pay back Gideon, we're going to sell this house. That's our plan.
This specific house.
This specific house.
Okay.
But there's no charge on it. So you'd have to get me to come in and sign a note for Gideon that says, even if it was secured, if it sells for 400, 500,000, don't mean to get sidetracked. Inevitably what happens is, imagine if the value of the home, if the renos don't happen, right? If the market shifts and the property values change, you're at an insane risk now. That property, maybe they didn't finish the reno, maybe they didn't even do the renos. Who knows what they did? But let's just say that property doesn't appraise anymore and it's at 300,000 and the market starts to drop.
Well, there's no accountability in the first place. If Gideon gets his construction money in there, it's supposed to go to construction. Who's enforcing that it should be
So
spent
that's the
on that?
first thing. So inevitably, the mortgage agent was from what I can surmise from the articles and stuff, and you can Google this, they were the ones they were the centerpiece of the lender to the borrower. And by involving yourself in promissory notes is so far out of what a mortgage broker should be doing that it's just so insanely irresponsible. Because for me to sit there and say, I'm a Hamilton mortgage broker, I know the area of the Sault Ste. Marie because I know a couple realtors who have gone there, flipped some houses, and I see their social media. The average investor is looking to me to grade this investment.
Yeah.
So if I put together an investment package and I ship it out to you, Mark, and Gideon, and I say, we vet these borrowers. They've done this over and over. This is a picture of them. This is what they look like. This is what they do. They're a great investment. It's so easy to take advantage. But inevitably, when the market shifts like it did and prices start to drop and the renos aren't getting done anymore, the equity in the home is no longer there.
Yeah.
So it's like a rush on a stock. Everybody tries to sell now. So all the people like Gideon, they start hearing, I'm supposed to get my money. It starts with like a small amount of I'm supposed to get my money back last month. Where's my money? I'm going to email Dan and ask Dan where my money is. And I thought, Gideon, you know what? Took a little longer to do the renovation. I'm just putting them off because as the mortgage broker, I probably know at that point there's a problem. Like, why can't I get his money back? That's my job. Why? What happened? Did the property didn't go up in value? They didn't do the renos? Like, so Gideon is going to start asking questions. So me as the mortgage broker, I probably have more people than Gideon. These people were doing it on a pretty large level. To give you an idea, I think it was like $80 million in first mortgages, and then I can't remember. You can look it up. It was a
bigger number for the second.
It was 150 million total, and I know that like 50 million of that was promissory notes, and the rest of it was like, I think it was like 8 to 10 million in second mortgages, which is what you would have been.
Yeah, that's right.
And then a large portion in first mortgages. But there was like $50 million in promissory notes. So imagine, Gideon gives me 60 grand. How many investors do you think are going to be calling me if I owe $50 million? So my phone's now ringing off the hook with angry people like Gideon going, hey, I need my money back. You know, you guys aren't as worried. You're probably really worried because you're like, the properties are dropping. At least I can sell it, but we got to sell it quick because the values are dropping. So it's a run. It's like a bank run. Everybody goes to the bank. They come to the broker and they say, I want my money back. And it's funny how quickly a Ponzi scheme can start.
Yeah.
Because in essence,
it's a house of cards, right?
If I keep having money coming in from other investors from this project that I'm selling, and I want to get Gideon off my back, why don't I just take their money, shut Gideon up, pay him his money, get him out of there so he's not bugging, wait for these investors to start bugging me for another 3 to 6 months, and then I'll worry about them. But as long as I'm bringing in funds, I'm not saying they did this, by the way, not at all. I'm just saying it's such a fine line of where things can go wrong. You might have started out with the best intentions. I want to make
money.
Well,
also, you could have made money on the first 4 years of deals, right? 100%. Like the first time Gideon got his money back and he made 35%, and he's like, "Ooh, let's do this again." Yeah.
Exactly. So he lends more money.
Yeah.
So
he tells his friends, and
so he tells us, and the cycle goes on. So how quickly it can turn. Now, again, I'm not saying they did that, but inevitably what happens is everybody starts to call and they want their money back. So how do I get their money back? I can't legally favor Gideon over all the other private lenders. Over you, I cannot. I have to go into the court process and some sort of receivership where the courts will now take over all of the assets and they will sell them to try to recoup all of the investors' money back. Now, whether they sell them at a discount, what does not matter. The courts will take over all the possessions and they will sell them. Whatever's money is left, you were in first position, you were in second position, and Gideon had no security. So in most cases, that money is now gone. And this mortgage broker, I know for a fact, I know people that loan money, unfortunately, through this channel. It's this weird thing that happens because as a victim of this type of, I don't want to say fraud because I don't know if it was illegal. Listen, there's nothing illegal about me being a bad mortgage broker and doing bad investments. There's nothing illegal about that. I might be not the smartest, but it's not criminal. Where it starts to become criminal is what was disclosed to the borrowers. Where did the money go, right? And I don't know that stuff. But this mortgage broker, the realtor that I know, the victim starts, there's this feel like, man, I got duped, but inevitably it doesn't start like that. It starts out with the investor holding out hope that they're going to get their money back. I've known this girl, I've gotten my money back before, inevitably it's going to come.
Yeah, they have trust.
They have the trust, they have a track record, it might have come back before. But again, as time goes on, the money's not coming, more and more people are knocking at my door to try to get the money back. So you go into this court protection where you're protected and you sell off the assets. So the promissory note people likely lose most of their money, all of their money gone. Like the realtor I know, she was, calling the broker every couple weeks. I was supposed to have my money back 3 months ago, 4 months ago. Oh, it's coming. And the victims have such trust in them at that point. They don't want to admit to themselves that they lost the money. They want to believe it until the last sort of breath. And then when that last breath is sort of squeezed out of you, when the mortgage broker says, we're holding back payment. That's the text she got. We're holding back payment. Nobody's getting paid right now. We'll do our best to get you your money. The embarrassment and that emotional drain remember, this is the victim.
The investor, the guy who put in his money. Yeah.
The Gideon who put his money in, albeit maybe irresponsibly. Like there's certainly some, questions to Gideon about why would you do such an unsecured loan.
Gideon, disappointed in you.
We're picking on Gideon. He's over there on the computer. Yeah, but that's it. And eventually,
he's the only one making money right now. He's actually working.
He's trading crypto over there.
We'll get into that.
Yeah, okay. But yeah, that's it. That's that. So eventually, when you are faced with the fact that the money's gone, this weird embarrassment takes over for the client, and it shouldn't. But that's the reality. The lender, in this scenario, they're hurt. They're embarrassed. They don't like to talk about it. This is something that honestly, if I was an investor, I would want more people to look into it. I mean.
Be a little bit more forthcoming with what's going on. People in general just don't really disclose their financial information to people, right? Like it's a personal thing, right?
And people chase easy money. It's easy to sell easy money. And I don't know, I've been doing real estate for 20 years. I don't know any get rich quick. To me, it's you have to put in the time. You have to work hard. You have to be disciplined. It's not always going to be easy. It's not easy. If I'm a private lender, some deals are going to be easy.
What would you say it actually takes, though? Because that's an interesting conversation. It's not easy, but like in your experience watching investors, you deal with investors all the time.
Yeah.
Like how long is an average investment really take to play out? Where the guy's like, I went into this. I thought I was going to just, sell it next year and make some, but no, I want to buy and hold this for a while. Like how many years are we talking before?
As a private lender or as a buyer?
As a buyer too, right? Like the guys who actually come to you to get a mortgage on a property and they have a strategy. I'm assuming you see them come back in 5 years and say, Dan, I'd like to refinance this or something, right?
Yeah, the cycle of most investors that we deal with is, they buy their first owner-occupied home. It's rare people buy a rental as their first, although it does happen. But most people buy their owner-occupied home. And then as time goes on, their owner-occupied home goes up in value. Not everybody knows that you can come back and pull the money out of that property, but you can. But most of the time, the first house that people buy is just that. It's the first house. Now, whether they want to sell that house and buy a bigger house, or whether they want to keep that house as a rental or buy another house, that's where the investment journey starts to starts for the client. And we, at that point, we always have a conversation. Okay, so what is it you're trying to do? To me, in sales, there's no easier sell than giving people what they want. So I always train my salespeople, just ask the client, what is it you're trying to do? And let me help you get there. Well, Dan, I want to look at options for buying a new owner-occupied house, maybe renting my existing house or selling it.
35% in Sault Ste. Marie.
But we'll do for the most part, a financial dive into that client, and we'll run numbers with them. We'll look at, okay, well, based on affordability, this is what you could qualify to buy if you wanted to upgrade, and this is what it would cost to keep your house as a rental. What do you think the rental income would be? But it starts there. Real estate investing doesn't have to be overwhelming. It's work, but it's also fun, right? Haven't you had fun on this ride?
Oh man, yeah.
It's fun looking
those texts when those texts at like 3 a.m. when it's flooding and you're that's
Yeah, but that's the point. It's like it's not easy. It's been work. I'm sure, Mark, for you it's been work.
But so somebody comes in and they buy their owner occupied, and then like how many years until they're coming down? Like I guess it depends on the market and their
depends
income.
When COVID hit.
Yeah.
Depends when COVID hit and made the money cheap. Depends on how quick the property is appreciating in equity. If you're buying at 5% down, you can buy with 5% down. But when you refinance to pull money out, the max you can take out is 80%. So if you're putting 5% down, it's going to be a longer timeline before you can come back and reaccess money versus 20%.
Yeah.
So I'd say on average 3 to 5 years is when there's usually enough equity to come back and maybe start looking at, the equity in your home is a great tool for investing in real estate. For those that don't know, when you use equity in your property, you can write off the interest on that money. And it's not
As long as you're using it for business.
As long as you're using it for business, for real
Not for
estate.
buying a jet ski.
That's exactly right. You can pull out money to do whatever you want, right? But you can't get the write-off on that. You can't buy crypto, you can't buy stocks and write that off. But you can buy real estate. So finding ways to create deductible debt through your owner-occupied home is not easy, but real estate is one way to leverage the debt. And traditionally, it's been relatively cheap in a market like this. It's not as cheap, especially if you're borrowing the down payment and then you're also borrowing the money for the mortgage. You're essentially financing the property 100%. So that makes it tough for investors in a market like this. It makes it tough to cash flow. The properties are more expensive. So that's what's driving a lot of investors to different areas. So
but it's just no surprise. Like if you put nothing into the property and it costs a lot of money, it's like obviously you didn't put any investment into it. So no wonder your cash flow is not great.
That's just it. You're right. It's an interesting thing because in COVID, you could borrow the down payment and get a mortgage and be cash flow positive. You could finance it 100% and you'd be cash flow positive. So that drove.
It's almost a no-brainer, right?
It's a no-brainer. How many investors were out there buying properties?
And we were talking about this last episode about how more and more investors are buying and fewer first-time home buyers, whatever. Like the percentage of investors, because if you already have the property and you can leverage it again and buy another one,
rich get richer.
Yeah, there we go. We're gutting the middle class on the show.
But that's exactly it.
Thanks for driving all the way here.
The people with the assets and the money acquire the assets and then end up controlling the cost to the people who don't have.
All right,
we're
assets. Calling this episode "The Dark Side of Lending."
Yeah, that's what I thought too. As soon as you said it, that's the title: "The Dark Side of Lending."
Oh, I love lenders. I love banks. The bright side of lending.
Well, that's another question. Like,
Darth Patton.
is getting debt good? And I don't know.
It can be. Yeah. Responsible debt.
Because I think a lot of our listeners have that. Like, debt is bad. I gotta pay this off, right?
Yeah, which is a great way.
You make a living getting debt.
Yeah.
So you see it you see it in a different way. So maybe clarify that too.
So for sure. Okay. So the debt should be divided into two categories: non-deductible debt and deductible debt. In its essence, non-deductible debt should be paid off as fast as possible. Okay, you pay off non-deductible debt and you leverage deductible debt. That's just the basics.
So what's one example of non-deductible debt?
Non-deductible debt would be I'm pulling money out of my house to invest in the stock market. You can't write that money off, okay? And again, I'm not an accountant, but writing your money off helps you at tax time. It's a deduction from your income.
Yeah.
Okay, it might result in you getting more money back. It might result in you paying less money in taxes, but it's a benefit to you to write off your expenses.
So not like your wife's Gucci handbags.
Can't write off the Gucci handbags.
Unless
it's a gift, maybe. If you're gifting it to a client, maybe you could do that. But I'll leave that to the accountant. But so you want to pay off non-deductible debt. So things like your owner-occupied home, the mortgage on your owner-occupied home, you want to pay that down as fast as possible.
It's not deductible.
Right, non-deductible. However, you want to also, people say the term, you want to get your money working for you, get your money working while you're sleeping at night. So what does that mean? Well, that means you have to use your money to make money. And that's why people like borrowing against their home for investing in real estate. You are accessing large amounts of deductible debt. Where else are you going to get access to $100,000, $200,000? I mean, most people don't have that lying around.
Brent's couch.
Yeah, maybe in Brent's under the bed, Brent's couch, the backyard. But where are you going to get that? So it's. What was that?
Well, the deductible debt. Right?
Oh, yeah, deductible debt. So that's why people like using, because if you borrow, let's do the math, okay? If you're buying, it's not going to sound great, but if you're buying an $800,000 duplex today, and you want to, let's say that place is renting out, you're the real estate, pro. What do you think it's renting out for?
5,000, maybe 6,000 max.
Okay,
$5,000.
Let's go with 5,000. So if you buy an $800,000 home and it's bringing in $5,000 a month in rent. Okay, let's go over the cost. So you're going to borrow $160,000 for the down payment because that's 20% down. The cost on that, you borrow it off of a home equity line of credit. Cost on that per $100,000 is about $660 a month. So just by easy math, that's for $160,000. It's about $900 a month, $960 a month, $990 a month.
This guy's a math whiz.
For a guy who says he doesn't like math, it's just daily life. When you do it every day, I guess you remember it easier. So let's say that's $1,000 right there, okay? Now the mortgage, you're gonna have a $600,000 mortgage. So that mortgage payment's gonna be, oh man, on $600K, you're gonna be close to probably $3,600 a month. So you're $3,600 a month for the mortgage, give or take, and then you're $1,000 for the down payment. So what other costs are you going to have owning that duplex?
Yeah, property tax, insurance.
So on an $800,000 house, what's your property tax? $300, $400?
Yeah.
Okay. So add that in. So now you're what? You're $4,600 plus your $400 for the property tax. You're at $5,000 already, plus insurance at $100.
Yeah, maybe utilities if you got to pay them.
Maybe utilities if you're paying them. So today, if you are borrowing if you're borrowing 100% of that property, you're probably cash flow negative. $100, a couple $100. So you're right. A lot of investors might say, not for me, that investment's not, that's cash flow negative. And I get that. I'm not a proponent of buying cash flow negative properties irresponsibly. But going back to your point, it's like, what are you putting into it?
Yeah, you didn't invest anything. You just went to Dan and said, give me some money.
Right. So if you had...
You might be investing $100 a month into it.
Yeah.
Yeah, that's exactly it. So if you look at it from the perspective of, listen, if I said to you, Mark, give me $500, not in promissory notes, but give me $500 a month for the next year, and at the end of it, I'm going to give you 20 grand. Sounds like a good investment, right? You're going to give me $500 a month. Well, real estate investing, for the most part, you have to look at it. If you're financing it 100% and you're cash flow negative, well, maybe putting in $100 to $200 a month, if it's affordable within your budget, is just money towards the investment. Because we know, what's an $800,000 property going to go up per year?
Yeah, if it goes up 5%.
5% is pretty fair. Maybe in a good market more, maybe in a slow market less. But let's say 5%. So what's that? 40 grand.
Yeah.
So if it's costing you $200 a month to make 40 grand in equity, and I know there's capital gains and there's some deductions there, but sounds like a pretty good investment on the surface. So the idea of, again, I say Southern Ontario because other provinces the metrics might work, but it's going to be very hard. If you're an investor now trying to buy, I got to buy a property in Ontario, Southern Ontario, that's cash flow positive, and I'm going to borrow all the money. Good luck. Like, it's very tough. Now, the positive side of this is that may change. As we know, rates are at I wouldn't say an all-time high, obviously, but certainly for the last 20 years, they're at a high that we haven't seen. And hopefully rates come down.
And then the price goes up.
The price will go up, but if I'm an investor and I buy a property today and it's cash flow negative, $100 to $200, it's not out of the realm of possibility that in 3 to 5 years, the numbers flip. Because my cost of the mortgage, if rates do come down, the cost of the mortgage will be cheaper and rent's only going to go up. So that's the sort of mentality that an investor today, has to have. Forest through the trees. It may not be cash flow positive today, but as time goes on, that will flip. Because I'll tell you, if everything was cash flow positive today, what do you think would be happening with the market?
Yeah, they would go insane.
Right. So it's an interesting time. I'm not trying to say now's the time to invest, but now's the time to be strategic with your investments for sure, because there's opportunity out there.
Yeah, okay, so that is a long roundabout way of answering the question, like, is debt a good thing?
I sorry, I know. It can be. Responsible
okay,
debt.
Maybe a quick thing just to get your opinion. So have you seen people in a bad situation, like aside from this promissory note thing, doing the right thing? Let's say they come to you, they can do the right thing. Like, have you seen people get in a bad situation? Like, what does that look like? Because a lot of people have this fear of, I'm going out, maybe it is, they're getting 80% loan for the mortgage, then they're getting 20% from their house. So now their primary residence is like, really leveraged, they're strapped. Yeah. What kind of things do people run into?
Overexposure for sure. One of the big things we saw over the last couple of years was, I sit here and I talk about borrowing money from a home equity line of credit, okay? Now that's a very dangerous thing to do in a market where interest rates went up so fast and so quick. So you might have been your average, everyday Jack or Jill looking to invest in real estate, and the numbers today make sense. You borrow the money off of a line of credit, you borrow the rest of the mortgage in a variable rate mortgage, and everything's great for the first 6 months. So you go buy another one, same thing. Rates are still good. You go buy another property, leverage that to 100%. You like variable because variable's at like 2.5%.
Yeah, it's cheap.
And all your numbers are running great. So what happens when, again, the government raises rates so quickly? Now all your mortgage payments go up. Your properties may not be cash flowing. Your HELOC payments are going up. It's a scary time. So a lot of investors who did this sort of borrowing over the last couple of years are probably the ones who are the most exposed right now. And that's a lesson. Equity is, again, it's good to borrow it, but responsibly, because this is the stuff that can happen. Your everyday Joe, Jack or Jill isn't expecting rates. I wasn't expecting rates to go up so fast and so quickly.
Yeah.
I would have never thought they would have gone up like that. But that's the risk of real estate. So people always attack the stress test. They say, "Oh, stress test is crazy. You have to borrow money at this crazy high rate." And just so people understand, when you're qualifying to borrow money from a bank, you have to qualify to borrow money at 2% above your contract rate. That's the stress test. So if your rate 2 years ago was 2.99, you were qualifying to borrow money at like 5.25%. So that was the lowest it was ever. To borrow that same money today, you might be qualifying at 7 to 8%. Mm-hmm. Now, if you think about that, when you're qualifying at the 2.99% or 2.5% mortgages, and you're looking at this stress test as 5.25%, you're going,
that's ridiculous.
Ridiculous. It makes no sense. Well, exactly.
It's double what my rate is.
And then what happened? The rates went up to basically where the stress test was. And it was I shouldn't say a good lesson, but it was a good example of they did a pretty good job.
Something the government did that actually worked.
Yeah, I mean, listen, if we're qualifying you to borrow this money and rates go up this high, you have to make sure you can afford that payment. Now, again, if you're taking on more debt, maybe not, but it's just interesting that we hit that trigger point with, with the stress test. But yeah, you have to be responsible. Borrowing money off of a HELOC, you have to understand, well, what are the costs going to be in a market where rates could go up? In hindsight, we should have certainly been better prepared as investors. We could have looked at things. When you have a balance on a line of credit, the balance is based on the Bank of Canada's prime rate, like a variable rate. So if rates go up, your line of credit rate goes up. If it comes down, your line of credit rate goes down. But not everybody knows that you can convert your line of credit into a mortgage. So there's reasons to do that, reasons not to do that. But, in hindsight, I think a lot of people, I'll certainly remember that if I ever see interest rates around 3% again,
lock it in.
Yeah. Lock it in. I mean, we had it so good.
It sounds easy to say, but when it gets to that point, you're like, I'll just stick it out.
I had a variable rate at like 2.25%, and about 3 months before the first rate increase, even myself, the bank came to me and said, you're up for renewal. You want to take a 5-year fixed at 3.25%? I'm like, 3.25%? I'm getting 2.25%. I'm good. Pass. All of a sudden, I'm at like 6% interest rate.
Yeah.
So you live and learn. That's important.
Well, and HELOCs are callable too, right? Like, do you see that happen often, where the bank actually calls the line of credit?
Not normally. So if you have to your point, if you have a limit of like $200,000, do we ever see the bank come back and lower that limit out of nowhere? Very rarely, because if your bank did that to you, what would you say? Would you want to bank with them? Exactly. Yeah. So the banks aren't out there to try to punish you as the borrower, right? If you have the money, generally they let you access it.
Don't they make money on lending? So that's their incentive. They do. Is to
it costs them money to borrow money, and that's an interesting thing, because mortgages are a tool for the bank to get your business.
Yeah.
The mortgage at a bank they're not out there trying to win business for rental properties, and they advertise low rates on mortgages because they want to build a book of business with you, the client. But when you're an investor and you're just trying to borrow money from a bank, what are you really looking for from the bank?
Cheap
money, right? Do you want bank accounts? Do you need new credit cards? No, you don't need any of that because you've got it set up. So for the most part, the banks just aren't looking to lend you money.
Still, when you sign the documents, they want you to go in and sit through the presentation.
Yes, but that's exactly the point of the bank. The bank wants to cross-sell you. One of the things you're seeing now more than ever is if you want to get a mortgage at a bank, they'll offer you one rate, and then they'll give you a better rate if you do your banking with them.
Right.
Do you know why they want your banking?
They get all the credit cards and
And they can predict. If I have your bank account, I can predict your spending. I can look at and see, where does he spend his money? When does he need money? There's algorithms I can study to figure out what type of product to sell you.
Yeah. Turns out I don't have any money, so.
Then we just move on to Mark.
Yeah, okay, there we go.
Right? But that's the bank wants to cross-sell you multiple product. They want a lifetime relationship. They want to give you the bank accounts, the credit cards, a mortgage as
You want to get your kids on there too, right?
Get your
Like
kids,
get your
exactly.
kids into
First, free savings accounts. But yeah, the banks are great. The banks have a great product, but they're a business, and we have to remember that.
Yeah, well,
Oh man.
that's where we'll disagree. The banks are great.
I love the banks.
Do you own a bank or?
Do not own a bank. Do not own a bank.
Yes.
Yeah.
Yeah, okay. All right. I think we covered a lot of ground there. I don't know. Is there anything else you wanted to get off your chest? Rants are encouraged and allowed, so,
I think I'm okay.
I want to ask you
Have a
about
sales
NFTs, but I don't know if you want to talk about them on the air.
NFTs? Oh, God.
Yeah.
We better not go down that road.
Okay.
Yeah, NFTs, crypto. No, I'm really thankful you guys had me on. It was a lot of fun.
Yeah, hey, appreciate it, man.
Yeah.
How can people get a hold of you?
You can email info@bettermortgageselect.ca. That's a great way to reach me. Again, we work with not just, I know we talked a lot about investors today, but we work with first-time home buyers. We work with debt consolidation. We do construction. We do everything revolving, mortgages, whether it's residential or commercial. So info@bettermortgageselect is the best way to reach us, and either myself or someone from my team would be happy to connect.
Awesome.
Awesome. Thanks so much, man.
My pleasure. Thank you guys both.
Yeah. All right. Till next time, folks.
Steward your wealth wisely. Thanks for listening to this episode of the Two Stewards Show. If you like my voice better, click subscribe.
And if you like my voice better, click share.
If you like both, give us a 5-star rating.
To interact with the show, feel free to reach out at hello@twostewards.ca.
We'll see you in the next episode. In the meantime, steward your wealth wisely.